Presently just logged in on two different computers. I'm sure you can hear me because I had a bit of a sound problem with one of them. So I just want to make sure that we do stay connected and live. So what I'm going to do is just share my screen with you so we can start to look at some of the things that are happening in the market. Thanks, Marlon, for hosting and keeping us connected. Okay. All right. So this is just a view of all the charts that presently looking at. Let's start by putting them on the daily time frame. Then we can kind of discuss what we have in a look at. Okay, so today's going to be an interesting day because of the federal funds rate. Now, I checked, I think from now it is probably 8.5 hours before the federal rate announcement out of the US. And that is going to have a bearing on the market. I think everyone is watching those markets. I mean, that's that news announcement. And everyone is keen to see which way the US is going to try and influence what's happening in the markets. So all 8 charts up. Remember, we don't always look at, we don't necessarily have to trade all of the 8 charts. But what is interesting, let's start with the Aussie 200 for guys who are trading that. So still we're at that bear breakout that we've been speaking about for a long time. We had a converging triangle. So it was there. That is always breakout mode. So as I always say, the market will not always end up converged, not going to end up as a straight line. So the market breaks out. But if you ever look at every time that there is a breakout of a triangle, we tend to come back to the apex of the triangle, so into the zone. So bears anticipate that the market will bounce off at one of these levels and then come back into the apex. And that's the initial objective. And if they achieve that, then of course they want to come back and test that low and hopefully break out. Now we are in a tight trading range right here. The last 3 candles, market is going sideways. So whenever in a trading range, your objective is to sell high, top of a trading range, or buy low. Okay, so tight trading range is also breakout mode, which means that at some point, even if the bulls accelerate, they need to get above this level here, which we had as a breakout point. Let me put it up. I know it's going to distract us a little bit, but I think it's important. So there is a breakout point on the 10th of June. That huge bear breakout. We broke out of this trading range low. And that's the level of resistance now that the market is looking at. Tight trading range right here. 1 bar doji. So all evidence of very strong bear price action. So if you're looking, depending if you're trading, of course, on the daily, you need to wait for the signal and sell off it. But if you're trading on a lower time frame, at these highs, you can be looking for opportunities to sell. You might need to put a pretty wide stop. If you're taking a reversal trade, you always start off with a very wide stop. Because the market can do a couple more pushes up before it turns. With my other laptop on, it's kind of distracting me. Let me just. Okay. Okay, so still bearish price action. This trading range. Is a big determinant of price action. If the bulls do break above that, then the initial objective is to get to a measured move off that trading range, which is just above that, but still, that's still all in a selling zone as far as the bears are concerned. So look to sell, but of course, look at your time frame and find the signal. If we flip across to the Nikkei 225, okay, we broke above this high here, high of 20th June, where we had that pullback. Breakout candle, follow through, although we had a tail on top, at least the body was pretty big, so the bulls controlled the breakthrough, follow through. Now we are in a pullback. So as far as the bulls are concerned, they say, well, hang on, it's just a breakout, pullback, and you can still accelerate. But where can they accelerate to? You always need to look at the actual breakout point, so the high of the bull candle, of the bull body, to the actual breakout point. If the bulls get the acceleration, that's where they want to test the beginning of this breakout. But they have a problem right now, because although they've triggered a buy here, they're buying above a bull candle, which usually fails, okay, because you want a bull signal to be a bull candle like we had here. Okay, you want at least the bulls to be controlling the signal candle. So again, we are in sell zone. If you wanted to be a little bit more precise, there was a signal bar for the bears. And just move the measured move. There was a signal bar. And we tested that. So that was a test of the breakout point. The bears defended that point, and the bears, you've got to expect the bears to want to defend that as well. So you can't be going long with a signal candle of a bear candle because it's likely to fail. So, unless you put a wide stop, which is a stop down with this technical level instead of beneath there. Then if it fails, just wait for your stop and wait for the market to turn. So wide stops is something that you can use when you're taking a trade that is likely to fail, but you have to be comfortable with the deep pullback. If the market does a pullback. Nasdaq 100. Now, so I said in one of the earlier shows, got a few times, I don't look to trade all 8 markets. Where there is correlation, I just try and pick which particular one I think is showing higher probability of one of my strategies unfolding. So I'm always comparing the Nasdaq 100 to the S&P 500. If you have a look at it, we are in a huge bear channel. Okay, that high and that lower high, and you connect to the bottom. So the bears who sold anyway in here, if they're keeping their stop at the correct technical level, which is at this channel point. So if you're a long-term bear, then you can be adding on to your shorts, anticipating that even if we do go up, at some point we will bounce off the channel and continue to sell. With a tighter channel, lower down in here, which was signs of strength by the bears. They contained the price quite low. And then, the descending channel line and the ascending lows created some form of a breakout point, converging triangles. It's a variation. So the market broke out above that. Bears anticipate to come back and test this level, which is in the apex of the triangle. So we might be having a bear, breakout, pull back, and then acceleration down. So this is still, we're still in a sell zone. Just by looking at the charts that we have, we are in a sell zone in this area. So if you're looking at this chart, looking to for opportunities, you're going to be saying to yourself, bears have been strong. Again, going long if you're on the daily time frame, although this is a low test candle, closing just at the 10 EMA and the low test of the 20 EMA. Promise you're buying above a bear candle, which is always a weak signal. If you're going long, you prefer to be buying above bull candles. So we're still looking to go short. I don't think just looking at the charts, there is still a higher probability that call it the market crash, is still in effect. Okay, these pullbacks we've seen are just pullbacks in a bear channel. Okay, so it doesn't mean that the crash is over. So you can be patient as a bear, wait for this to fail or wait for a double top. If you're a bull and you're looking to scalp, in other words, in and out of the market and take your profits quickly, yeah, you can look to take a trade, but be wary of the reversal. Then France 40. This is interesting, just for you guys, just as a comment. I've put the France 40 as an CAC 40 as an alternative to the Euro Stoxx 50. So between the Euro Stoxx 50, the France 40, and the German 30, my goal is to find two of those three to bring into the 8, which show a higher volatility. And by my analysis of late, the one that's been showing more volatility, the two that are showing more volatility is German 30 and France 40. So that's what I'm trading presently. Of course, if the volatility changes and I look at it at the end of the week, then I can drop one of those two, German 30 or France 40, and bring back the Euro Stoxx 50, because they're in the same zone. The other two are obviously reflective of particular economies, whereas the Euro Stoxx is more of the general area. Again, we are in a sell zone. Bears want to see this sell trigger. The market went up once, twice, third, so it's some form of a wedge. We're still in a bear selling off. And as far as the bears are concerned, they're trying to see if selling off at the top here, we can come down here and get beneath this bear candle and trigger the sale. So if you're trading on the daily chart, you could put an order here beneath this candle and then put your stop above here. Or if you're trading on the 5-minute chart, as we're doing, look for an early entry with a wide stop and hope that the market will go down. So that's the trade, one of the trades that I'm presently in. Very wide stop, like I showed you up there, and anticipating that the market will sell off and hopefully get to close this gap, which was the breakout, the gap up on the morning. So in the morning we had a gap up on this particular chart. Okay, so anticipating the bears wanna sell, and come and close the gap. And if they are strong enough, whatever price session we get here, they might accelerate down. We'll have to wait and see what we get. So I'm in that trade, and I am holding on to that particular trade. I took it off here. Okay. Now, this price action is quite interesting. So we had a gap up, and whenever you have a gap up, it means obviously that the bulls are strong because they managed to push the market up. And then the follow-through candle. So it closed way down here. Whatever the news that took place until this market opened, whatever took place in the economy, bulls controlled the opening plus the first candle. You would have expected the bulls with that much strength. You'd have expected the bulls with that much strength to have a follow-through candle and keep buying. Yes, the market has gone up from the open, but these patterns that have been created are indicative of resistance by the bears to the bullish strength. So we had a triangle formed here, which is always a breakout mode pattern, expanding triangle, and the bulls came and the expanding triangle bottom held, and the bulls came and managed to buy. But when they got, because their goal is to break above the high of yesterday, which is the green line. There's the high of yesterday, that's the objective. But when they got here again, they met resistance. One thing which, just to avoid clutter, it's not on here, but there is the expanding triangle, the range of it from its high to its low. So we got to the measured move of the expanding triangle. So even though they broke above this pattern, okay, and if you really want to see which one is a breakout candle, the breakout candle is this candle, okay? And if you're looking for confirmed breakouts, or if you're looking for a breakout that's successful, which is a confirmed breakout, you need the candle breaking out, and then you need follow through. So while they broke out above it, they failed to create follow through, which indicates again the existence of strong bears in the market. So bears are defending the high of yesterday quite strongly, and bears want to try and accelerate the market down to these levels. Whether they'll get there or not, we'll have to wait and see. Okay, I'm just gonna take that off. Let's keep the charts clean. Nasdaq 50. Let's start off with the daily. Bit messy, or no, I think it's my measured moves. Okay, so whenever you get sight of a one-bar doji candle, it's always there's always a high probability that after any breakout above it or below it, the market will aim to make a measured move of the height of that one-bar doji, because a one-bar doji is basically a trading range. It's one-bar trading range. So these measured moves here, which I will delete because I have marked here. So these measured moves marks the extent of any breakout above this particular candle, that with measured move of it. If we break out beneath the low of it, this will be the measured move. Okay, so just to keep my charts clean, because I've already, and I'm leaving the measured moves in. I'm going to delete that. If you have a look at it, bears again, all the way from there. They break out, pull back, and bears wanted to accelerate. But that pullback, what it means that the bears are still in control. We are in a spike and a channel. So there is a breakout spike. And now the bears are hoping that the market will continue to work its way down from there to this bottom, come back. So bears are hopeful that the market will do that, okay, and just continue selling off. So we still definitely in a bear trend. This pullback tested the breakout points, confirming that the bears were strong. Okay, so if you had been in here and you'd seen that even on the 5-minute time frame, you'd have tried to trade a reversal trade and hopefully get down. If you didn't get it, then there were opportunities to sell. Okay, so if we drill down to our 5-minute chart, okay, so this is good for the bears. Earlier on in the Asian session, this was a good trade to have taken. Reason for that is you had a gap up. Now, this gap up is different. If you have a look at this, gap up, bear candle is different to what we had on in France. France 40, we had the gap up, but then with the bull candle, which would say to you, okay, there's strong bulls, although bears are resisting them, from this triangle, but be wary of the bulls. Whereas, let's put it, Hang Seng 50 gap up, and the first candle is a bear candle, sold off, not strong bears, but still it's a bear candle. So one of the patterns that we look for is simply an opening reversal. So market went down, first attempt to come down, second attempt. That's even a good trade to take. Then we entered into a trading range, trying to close a gap, which would have given you a warning that this market might reverse. So if you had a couple of bull candles here, it would be best to close your trade at break even or rely on your stop, wherever your stop may be. Go to the low of yesterday, broke out, immediately failed and created a converging triangle, breakout mode. So if the bears had been strong, this indicated that the bears were weak, because if you're breaking out beneath a strong level of support, like yesterday's low, you want to have follow through. But the fact that they failed to have follow through means that the bulls were resisting this. So this, by this market closes, you have to work it out in local time, but the market does close for an hour from after the morning session. So it closes at 3 a.m., 4 a.m. GMT, and then opens an hour later, 5 a.m. GMT. So there's a gap up on that open. So if you had taken a trade anywhere here and you were trailing your stop, if you see a failed breakout, you got to look to get out above a couple of bull candles. So anywhere above here or before the market closes. This close is a very impactful, very strong influencer. You got to treat it whenever the market opens. I treat it as if it's the way I trade red news. Got to wait for information. So even though it's an hour, a lot of things can happen. And so sometimes you have no gaps. So you gap down, gap up. So be very cautious if you decide to stay in the market and you get stopped out. That's perfectly fine. We created a wedge test of the open of the day, magenta line. That was the open of the day. And whenever you get a wedge, you wait for a lower high. We didn't quite get a lower high. You want 2-3 candles of separation. If you decided to take that particular one, you'll have to put a measured move stop. So if you take a trade, we know, yes, that's a wedge, but I'm going for a lower high, which we may not get. We didn't get in this case. You need to put a measured move stop. Okay, protect yourself from images reverse and you want to get stopped out, and then it continues in your direction. Then we got to the bottom of yesterday again, which, remember we said whenever you have a converging triangle, the market tries to test, to come back to the, after breakout to the apex. We didn't quite get it with here and we didn't quite get it here, but the bulls defended it. So the bears failed to get below this double bottom forming, below the low of yesterday, below the apex of the triangle, and below the low of the day as the day is unfolding. So bulls, pretty strong. If you wanted to take a trade, you could take a trade here. Excuse me. Bottom of the range, close to yesterday's support, you can buy, but you got to put a measured move stop, just like you would put a measured move stop here until you get a breakout, pull back, and a higher low. We didn't get a higher low. That's a higher low, but you're getting almost to the middle of the trading range. If you're still going to take it, your stop is going to be down here. So you got to decide. You didn't get the higher low, but you can still take the trade because you don't know how far we can go. Then we got to here. Now we have the double top. So if you're looking for a trade to jump into, this double top is a perfect signal for selling by the bears. Broke out beneath the low of, the open of the day, tested with a wedge, bit of a wedge near 1, 2, 3. So nice for the bears. And the reason it is every time you see a wedge pattern, we really are just looking for, it's evidence that the market has tried to do something 3 times. So yes, the bulls can see that. They can see the open of the day. They tried once, failed, tried again, failed, tried with this candle to break out. This candle didn't quite break out above that. So as you can see, it went up, came back. The body is still within that high. So the bulls have tried 3 times to get above double top. So the bears have defended this double top position. So it's a very strong level of resistance. Could also just additional factors. So the more factors that are in your favor for whatever strategy you are trading, because now you're looking, you need the probabilities to be as high as possible in your favor for whatever strategy you're taking. So here we're looking to go short. All we need now is a bit of bear strength, close beneath any moving average, both fine, but one is fine. And then again, we need a lower high. That's what we need to get. Whether it tests this open, it tests that level, whatever, we need a lower high. And there's 2 places you can put your stop if that sets up for you. It's correct to put the stop there. Change the color of that. So you can put your stop here, okay, because this level has been tested 3 times, been tested by the wedge, been tested by wedge. It's a pretty strong level, so you don't want to be in the market if it goes above there. If you want to be conservative, which you can, that's still fine. Measured move of this pattern, okay, because we're expecting a lower high, you can put your stop up. So the wide stops that you put, which then reduce, obviously the wider the stop, the lesser the lots that you can trade, so that your risk is always contained. Where you use a wide stop with measured moves is when you trade in the open. I mean, if you're looking to take a trade and you see in that, because you don't know at this stage whether the higher probability event will occur. The higher probability event, call it 60%, is that the market sells off. But the market could still do a measured move up. So if you're aware of that possibility and you're taking that trade at the open of this market or open of any market, okay, then you need to use a measured move stop. Okay, so you can take that whole range. You can go like that. They are the lows where the market is gone up. You could use the lows if you wanted. So lows are a lot more aggressive. You can put your stop here, or you look at the whole range. It's still legitimate. In case you get one more or two more pushes, so you put your stop here. That's where you use a wide stop. But when you get confirmed levels like this, you can use a tighter stop. And that is perfectly fine. Okay, if you've seen the market going like this, then you think, hey, I'm not going to wait for the pullback. You're going to use the measured move stop. Okay, if you're going to wait for the pullback, then that would be a tighter stop to take. So that's if you want to be active and you're looking for trade to take. I'm just doing this so that when I eventually go back to the daily, my dailies are not cluttered. Okay, S&P 500 daily. So again, this looks almost like the Nasdaq. Look at the Nasdaq. There is pretty strong correlation. The structures are different, but in terms of correlation and trying to choose which one actually comes down to preference and what you think is clear. Remember, you have no control over what actually happens during the day. So I'm looking at the daily, say, I think this is a higher probability. It might turn out when you look at it, I think yesterday or the day before, Nasdaq turned out to have had easier patterns to read, but you've already made your choice. So there's nothing much you do about that. So channel, big bear channel. Okay, I know the bulls have been celebrating, hey, the selling is off and is over, the crash is done, we're just gonna fly away. I still think we don't have good news as yet, because the bears are strong. They need to always break above the channel, which they did here, but they had to break above. At this stage, it was a lower high, this micro double top, which was 28th of June. They had to break above that. And they created a doji instead, which is immediate alarm bells for you to say, hang on a second, these guys are strong. Why do we have a doji that has been created? They have another follow-through candle, tells the bottom, tells the top, bear candle, bear candle, bear candle. So the bulls are not demonstrably strong. So in other words, the probabilities still favor the bears. It is not unusual that any first attempt to break above a channel fails. Okay, that's why we're constantly always searching for breakouts. Now, if you're trading on the daily, you don't want to buy this even though it's a low candle. I just need to close Siri. Asking question. I don't know. Okay, so you don't want to buy above that because that's problematic for you. Okay, it's a bear candle, might go up, it won't go far, but you want to look for shorts because we trade in intraday. We want to try and sell high, and then see if during the day we get to these lows, you can see that there was buying at the bottom here. So you can expect any kind of reversal that the bulls may come back and buy. So every time there was bear selling, buy, selling, buy, selling. All these tails are evidence of the bulls coming in to buy. So we just got to keep that in mind when we are looking at a lower time frame. So presently, I am in shorts with a wide stop. Interesting, market opened right almost on its close. Bulls were strong. Now the bulls were strong, you got to ask yourself, hang on a second, guys, you are so strong. Why have you allowed the bears to create a failed breakout? So immediately that gives you an alert that the bears may come back. Bulls tried to break out again above that, failed, and again we create an expanding triangle, which is breakout mode. Bears tried to sell off here. So this is a classic example. Let me just pull this back. So that's an expanding triangle. Okay, this is a classic example of what I'm talking about, that if you sell that, instead of waiting for the second signal, you need to have a measured move, because the market might just create another move. Okay, so if you're saying, okay, I want to sell here, then I gotta look at the height of the, you're gonna have your stop way up there, like I got my stop out of sight somewhere up there. Because the market may just create, another push up. But if you didn't, you could then sell that or sell anywhere within there. Okay, so again, you got to make a choice. These two markets are correlated, S&P 500 and Nasdaq. Then the German 30, DAX 30, which, your computations and charts, they use the very same thing as the DAX 40. My broker still is DAX 30. They will change it someday, they told me. Breakout, pullback. Now, I think it was Hang Seng 50, if I remember. Put it on the daily. Yeah, we said there's a spike, pullback, and the bears are creating a channel. If you ever look at German 30, a spike in channel is much clearer. There is a spike, and there is a spike. So pullback, and the market created a channel. And now we broke above the channel, but look at the breakout, a bear candle, doji, which indicates that bulls creating the breakout for a week. I took it out, but let's put in the measured move. You can see how we got exactly to the measured move of that 1 bar doji. At the same time that we got to that measured move of the 1 bar doji, market was also testing these previous highs where there was selling taking place. So bear is pretty strong. So although we've broken out of this particular channel, we've created a trading range, and the bears are continuing to sell. They want to get down here, which is the low of the year, and hopefully, break out beneath it. Five-minute time frame. Okay, so I took a trade down here. I'm in a pretty wide stop, and I'm just going to let it play out and see how the market reacts to that. I had a few earlier trades where I banked a bit of profit, so pretty comfortable with where the market is. We came to test that breakout point. The bears want to get down here to test that particular, the low of yesterday. So if they do come back to this area, which I marked in gold, that's a breakout point. We did a gap up. Gap up, interesting enough, bull candle, but look at it. Huge bull candle that tested, that went above the high of yesterday, but sold all the way to the bottom. So it became quite a strong reversal candle, high test candle, and the bears followed through. So the bears have been strong and they want to continue to sell off and hopefully get down here. Okay, let's have a look. This on the daily. UK 100. Daily time frame. Again, so I hope you kind of get a sense of bear sell-off. Okay, let me put this back. I took it off. There was, again, another convergent triangle in here. So same pattern we had. And then the bulls created this doji. They broke out, but they were selling right to the close. Now, what's interesting about that is we never go to the measured move of that. So the bears have prevented even the bulls to get to a measured move of this one bad doji. So bears are defending this zone. You can see every time we got up there, sold, sold, selling, selling. So the bears want to keep selling. Though there was a gap up today, they want to sell and hopefully trigger a sell down here and, try and, get above the midpoint of the range so far of the year and go all the way down. Now, if you want to take this trade here, if you turn the daily, it is a one bar doji. So let's use another. You just have to be cautious where you put your stop. Because if that's triggered and the bulls come back, they want to do a measured move to get to that. Although we didn't get to a measured move here, that's where you need to put your stop if you're taking a trade beneath. It's essentially, although it's a high test candle, but it is essentially a doji, a one bar doji. So the market might just try and test that. Okay, which is still within the bear breakout. And we broke out here. Broke out here. That's almost 2 minutes to go. So all of this is still a sell zone. Quickly, what a bit of a mess here. So within, you can see we created another expanding triangle. Can't remember where I took my short. Probably I think it was somewhere in here. And we still stop is up there. We're just going sideways. So gotta leave it and see if the bears get the objective to get down here and test the open and maybe accelerate to test the gap. Most gaps close. We don't know if it will close today or it will close tomorrow. All right, guys, we are a minute away from finishing today's session. Very quickly, we have finalized with Paul Bottrell and James in the office. Coaching program, 112 hours of coaching with me over 12 months, which consists of the third and fourth Wednesdays of every month, plus 12 hours of one-on-one coaching, 1 hour a month, plus a 4-hour workshop on capital allocation, capital management. So 112 hours that will absolutely transform how you trade. James will post the details on the platform on ATW. Have a look at it. All right, guys, thank you very much. We have come to the end of the session. We shall see you next week. Happy trading and keep a lookout for those trading opportunities. Bye-bye. Thank you, Marlon. Cheers.